Well, Australia's new capital gains tax reforms will come into effect from July next year, so the clock is ticking for investors and businesses owners to understand what is changing, and whether there are steps worth taking before the new regime begins. Joining us now is John Van de Pol from Morgans. John, welcome to you. Well, what are the considerations then? I mean, there is a year to go here before those changes come in, which are significant, of course, because this, particularly those capital gains treatment, that affects all those assets.
Yeah, absolutely. They are very significant changes, and I'm still trying to get my head around them. Every time I look at it, it gets a little bit more complex than I first thought. So the main changes coming into effect so far impact individual investors, and also trusts are in the gun as well. Self-managed super funds, nothing changed. Oh, sorry, superannuation, nothing changed there. Nothing changed with companies, and nothing changed with investment bonds. So we're just looking really at individuals at the present time. I think what these changes really sharpen my focus on how I look at the different vehicles that I'm investing with. Thanks for the slides. So certainly when I'm looking at superannuation, where I was with Division 296 and some of the strategies I was thinking about, I'm now revisiting those, going, maybe that's not the right strategy, such as those large balances taking money from super. When it comes to trusts, you really got to, I'm starting to think about that and how I'm invested, and more of a focus on income. Capital growth is potentially a problem for clients. So superannuation definitely targeting growth, trusts looking to just target income, and probably just investing in people's individual names, also more focused on income versus capital gains because of the problems thrown up by these changes.
Yeah, in fact, John, let's bring up the next chart then, just reflecting those changes, and as you've highlighted here, particularly for those trusts.
Yeah, absolutely. I mean, so just remember the changes relating to trusts haven't become law yet, but I think it's safe to assume they probably will in this environment. The trusts are going to have to pay tax at 30% regardless, and that's got to be paid within the vehicle. So even after what is proposed, after taking into consideration franking credits, the trust is still going to have to be in a position to pay any remaining tax liability before those distributions are made. Now, moving on to the distributions, trusts have been a powerful vehicle for passing money on to people in those lower tax brackets. Going forward, this minimum 30% tax is going to apply. So you really have to think about, if you've got a trust, I still think trusts will be relevant, but if you've got people in there who you've been kicking funds out who are in that lower tax brackets, you're going to need to rethink that, because why would you have someone paying 30% tax when they're maybe a 0% taxpayer? So you've got to look at it differently. The other thing that's really I found fascinating going through this process is looking at direct share portfolios versus ETFs. So you may have a holding of 5 different shares, and they do over a period of time under the indexation model, they do a whole lot of different things. You have 2 that shoot the lights out, 1 loses money, and 2 who just tread water. You could actually end up with quite a perverse tax outcome, where you suddenly find yourself having to pay a lot of tax, even though there may be some losses in those portfolios, versus exchange traded funds, where because of the mechanism as to how they're just calculated on purchase price versus disposal price, the volatility of the underlying shares, because an ETF is a bucket of investments, doesn't actually flow through as a capital gains tax calculation. So we've actually done some really interesting modelling showing how ETFs will potentially perform a lot better from a tax perspective to individual shares. So I probably need to get my thinking cap on a lot more about exchange traded funds going forward, because that may deliver better outcomes for our investors.
It's interesting, John, isn't it? Because particularly if you look at the demographic breakdown of how people invest, it is those new and younger investors that very much favour the ETFs. It's streamlined, isn't it? Plus, of course, you get access beyond Australia's shores without, I guess, the tax implications.
Absolutely. I mean, I banged on the last couple of times I've been on your program, just talking about how I feel young people have really been treated poorly here. A lot of young people trying to get on the property ladder have been using shares as a alternative to raise those deposits that they need. And suddenly they're finding themselves in a situation, regardless, that they're going to have to pay a minimum of 30% tax. It's it's a little bit mind blowing, but I think exchange traded funds, certainly for when I'm talking about trusts, talking about individuals investing in their own name, I think they will certainly be something that I'll be considering a lot more for my clients. I already do, but probably looking at it in a lot more detail moving forward post the 1st of July next year. But superannuation, just going back to that, feel really positive about that. I mean, everyone's got superannuation, and a lot of clients got self-managed super funds. Certainly, that is where you're going to go after your capital growth, because no CGT changes were announced in that last budget. So it's all the old rules still apply.
Well, I mean, John, you could argue that's the government's intention, isn't it, to skew the favour of super?
Well, hasn't always been. I mean, and look, I keep saying to my clients, don't think they won't come for super again at some point. It is a massive, pot of money, accumulated in superannuation, and maybe we will have to contend with further changes. The other one that has been spoken about is franking credits. We are one of the few countries in the world that has a franking credit system. I think it's very beneficial. It does mitigate double taxation. I'm very positive on it, but I know some of our friends in Canberra not so much. So if change comes there as well, that again will change alter my mindset as an advisor and how I do things. So lots to consider, and I think advisors definitely have to look at this differently and take a different approach with their clients on how they're going to do things come the 1st of July next year.
John, just getting back to, we had that chart up making those comparison of marginal tax rates. Investment bonds, how attractive are they?
I think they're really attractive for the right person. And interesting, last week, Generation Development, which is one of the biggest listed companies playing in that space, put out a cracking quarterly update last week, and it was simply fund inflow. So it's already started. I think Division 296 changes with super got the ball rolling. The budget changes definitely tip the scales in favour of those investment bonds. They do pay 30% tax in the investment, and that's really important to note. So again, you've got to consider the investor's marginal rate of tax. If they're only paying tax at 15 cents on the dollar, an investment bond actually doesn't make very good sense. I mean, you're effectively saying let's pay more tax. So, but for those people who are paying at 47 cents on the dollar when factoring in Medicare, I think the investment bonds are really powerful. Taxed within the bond, after 10 years, you're able to take that money with no further tax to pay. You don't need to put anything on your tax return. You don't need to worry about capital gains tax. It's part of the Insurance Act. So I think they're really powerful, and certainly I know my own client base, there's a lot of conversations going on there, and quite a few clients are actually going down that route. But I probably need to do another section on that, because I'm getting a lot of inquiry from clients and also through my LinkedIn wanting to understand a bit more about investment bonds.